Hello, Jody Samuels here from FX Trader's Edge. Welcome to the market analysis for July 22nd, 2016. Please read the disclaimer. Thank you. The Fed and other central banks want market stability, which is why rates have remained where they are in the U.S. post-Brexit environment. The Fed watches global influences very carefully, preferring not to upset the apple cart, which could affect global economic recovery. On the week, stocks are at record highs, eking out marginal new highs this week. The dollar across the board traded higher, with the euro breaking through the 110 level with the Munich shooting and closing the week lower. Oil is closing the week soft below $45, gold is flat, and 10-year yields are flat. The biggest movers on the week percentage-wise is the pound, followed by oil and the euro. Looking at our market correlation chart, the major change in dynamics is the divergence between oil and the S&P. If you recall, since January 2016, oil and the S&P were positively correlated, and that dynamic has shifted. It changed a month ago after Brexit, where the S&P continued to make new highs in blue, and oil continued to track lower in magenta. Perhaps that was because the Fed put interest rate moves on hold after Brexit, and stocks, which are normally fueled by low rates, continue to track higher. We still need to watch that relationship going forward, since the Fed has been watching the stability of oil as a proxy for economic stability, for global economic stability. Moving on to the S&P, while price has made new highs this week, the week's activity held a pretty narrow trading range. So watch next week's FOMC statement for any changes in monetary policy and see how that will affect the markets, and it will. In the meantime, this is a chart of the S&P, the 4-hour chart. And the S&P will track higher if we take out this week's highs, and will likely correct lower if we take out this week's lows of 2158. And this chart shows the Fibonacci retracement of the last swing move from 1990 up to current price highs. Looking at this Fibonacci retracement, this is a way to gauge the potential correction. 23.6% takes us to 2132, and 38.2% takes us back to 2105. But we can only expect this type of correction if we take out this week's price lows and last week's price lows, which is indicated by this magenta line. Moving on to the euro held a pretty steady trading range all week, but did trend a bit lower, and of course broke down through the 110 level today. For next week, we have to see if the euro will follow suit, trading lower. Certainly our Elliott wave count has been calling for lower euro prices, so we have to see what the weekend brings and the start of next week's trading. On the pound front, while the pound held the 130.65 to 133.15 range, we have to look at the broader range post-Brexit, the low being 128, the high being 134.80. So if we break through these ranges next week, on the high side or the low side, we will test lower or we will test higher, and likely be confined to the broader range of 128 to 135. This is oil. We already spoke about oil and its inability to track higher with the S&P, and notice how we have taken out this week's lows today. So let's look for a new trading range for next week, potentially. Perhaps the new trading range will be a $45 cap and slightly lower levels. But certainly this is one to watch and one to watch the correlations with the S&P to see if it continues to be uncorrelated or if the correlation comes back. And when I say uncorrelated, actually it was negatively correlated for the last few weeks. So uncorrelated is the wrong word. Finally, gold. Gold has remained fairly lackluster over the last week. But from an Elliott wave perspective, we do see these market moves in gold as a correction off the market highs of 1375. And again, you can measure the Fibonacci retracement of the last swing move higher in gold to see where we are in terms of this correction, this retracement down. That concludes this week's market analysis, but next week, next Wednesday, stay tuned for our global market analysis, where we will look at the Elliott wave analysis of the major global markets and look at the fundamentals as well in a more detailed approach. Thank you. See you next week.